We're certainly excited to present on another New York MBA Affordable Housing webinar. A little bit more about our New York MBA Affordable Housing Committee before we get started. Our committee is chaired by Brian Garris. Brian Garris is the president and sales manager of residential lending for Catskill Hudson Bank. The New York MBA formed the Affordable Housing Committee in June of 22, and the purpose was to develop a committee as a New York MBA resource for community investment opportunities by facilitating engagement with housing stakeholders and nonprofit affordable housing agencies that strive to promote affordable housing, security, and community development services. Our goals and objectives are to collaborate with housing resource agencies and industry stakeholders to support local housing agency and affordability initiatives statewide via service opportunities, identify systemic challenges to affordable homeownership and a healthy real estate ecosystem, evaluate and promote available down payment assistance and grant fund options that represent functional resources for homeowners in low to moderate income census tracts, and to support and promote the initiative of the National MBA Home Pledge for All. The New York MBA Affordable Housing webinar series is held the third Friday of each month, starting at 12 p.m. Eastern Standard Time. And next month, we will be our series will be presented by Jim Bopp, who's the VP of Renovational National Lending at Planet Home Lending. But back to today, we're very excited to have Bill Teague joining us and presenting. So a little bit about Bill. Bill Teague started in the mortgage business in 1989. Since 2015, he's been the AVP of Business Development with Sonny Mae, and he's responsible for relationships with Sonny Mae participating lenders throughout New York State. Prior to working for Sonny Mae, Bill was president of Best Interest Mortgage Corp, a company that he founded for 15 years. Bill also spent time with M&T Bank as a loan officer. Tri-City Funding as VP of Sales, and Home Funding Inc. as a sales manager. Bill is also in charge of Sonny Mae University, an ongoing training series for Sonny Mae lenders. We are very excited to have you with us here today, Bill, and I will hand it over to you.
All right, thank you very much. I appreciate that. I love this concept, Affordable Fridays, especially here in New York, where it's a challenge, right, to get first-time home buyers in. So I'm going to go through a PowerPoint presentation with you guys that explains a lot of the benefits that Sonny Mae offers to aspiring New York homeowners. I'll try to stick to the slides and not get off track too much, but sometimes that happens. So, right, Sonny Mae is here, right, to help New Yorkers with their dream of owning a home. And for low to moderate income people, that's especially challenging because of several factors. But that's where Sonny Mae can come in and help. And we built these programs to try to meet the needs and some of the unique needs of low to moderate income first-time home buyers, and especially home buyers, minority home buyers as well. We're going to touch on something today that we call Give Us Credit, which is an alternate underwriting method where, well, for borrowers who don't have a lot of banking contact and credit history. And we'll get more into it as we go through the slides. So if we can move to the next slide. State of New York Mortgage Agency, we are a public authority created by the state of New York in 1970 to provide affordable homeownership to low and moderate income New Yorkers. So what we do is we work with a network of participating lenders. Some of you, I'm sure, work with a participating lender, and the lenders originate the loans. We design the loan programs. We set the guidelines for them, right? And what we do is the state of New York sells municipal bonds in order to raise the funds to purchase the Sonny Mae loans from the participating lenders once they're closed. And then we provide a lot of training and support along the way, especially for newer participating lenders, to help them get up to speed on what the different guidelines. I mean, the unique thing about dealing with Sonny Mae as a lender is you have to deal with what we call IRS compliance, because our funding source to buy the loans is municipal bonds. So that's a little bit unique. There's a learning curve for that, but we offer a lot of help along the way. So Sonny Mae home loan benefits to the borrowers, right? 30-year competitive fixed rate mortgages with low rates. There is We do have a slide in here with the interest rates. We tend to be certainly on our Achieving the Dream program, at least a little bit below market on interest rates, which makes us attractive. Right, we have low down payment options. So as low as 3% down, which to us in the mortgage business means a 97 LTV on a Sunny Mae first mortgage for 1 and 2 family properties and condos. For those of you in New York City, Westchester area, we can go to 95% loan to value on cooperatives. And for 3 and 4 family homes, 5 to 10% down payment, which is 90 or 95% LTV on 3 and 4 family homes. And again, we require borrowers to have a minimum of 1% of the purchase price of the home in their own funds in order to be eligible, right? So 1% for 1 and 2 family homes, 3% for 3 to 4 family homes and cooperatives. So it's some of the eligibility criteria and the benefits. Sonny Mae also, and this is a big feature and probably one of the primary reasons a lot of consumers seek Sonny Mae financing, is our down payment assistance loan. We call it the DPAL, right? DPAL. The amount, so any borrower using a Sonny Mae loan is eligible for the down payment assistance loan. It's the higher of 3% of the purchase price, or $3,000 up to a $15,000 max. So what it is, the DPAL is it's a second lien on the property technically, that sits there, and it's a 0 interest, 0 payment loan that forgives itself 1/120th per month. So at the end of 10 years, it's completely forgiven if the borrower pays off the Sonny Mae loan within the first 10 years, and a pro rata portion of that down payment assistance loan would get recaptured at the payoff of the Sonny Mae mortgage. We also have flexible credit requirements, right? You can use non-traditional credit, right? Alternative credit, things that don't appear on the credit report to help borrowers, to help build a credit profile for borrowers. So you have, that's one way to do it. With us, you don't need a FICO score with Sonny Mae to get approved. So you can even qualify with no credit history. And we're going to talk about that with our, again, Give Us Credit program, where you can get borrowers approved for Sonny Mae loans who have no credit history on a credit report and no FICO score. Borrowers who are light on credit history can also use a guarantor and or a non-occupant co-borrower to help them build credit depth and also to qualify. Another great piece of the Sonny Mae puzzle is Sonny Mae mortgages can be combined with government, nonprofit, employer type home buyer grants and subsidies. We are very, very grant and subsidy friendly. The reason for that is because we have no combined loan to value limit. So if your borrower is able to qualify for like the Homeowners Dream Grant or some sort of CDBG grant from the municipalities, or a New York State Affordable Housing Corporation grant, we don't worry if the combined loan to value with that grant or subsidy, right, when we look at the purchase price and the appraised value of the property, ends up being whatever the number is. There's no limit on it, right? So I mean, for like Habitat for Humanity loans that we do, we often come in with, combined loan to values of like 180%. So there is truly no combined loan to value limit, which helps free up, right? So grants that maybe your borrower couldn't use because of an FHA or a Fannie Mae restriction on combined LTV, you can use for Sonny Mae loans. We mentioned in this last bullet here, the grants from local nonprofit housing counseling agencies. Those are really great entities that operate in every state of New York. They kind of go under the flag of, gosh, now I'm blanking, HomeSmart New York. HomeSmart NY, that's kind of their umbrella. But there's agencies like these operating in every county in New York State, and they are kind of gateways to a lot of grant and subsidy programs that borrowers can really use. They also offer pre-purchase home buyer education, and on most Sonny Mae loans, it is required that at least one of the borrowers on the transaction take pre-purchase home buyer education. So Sonny Mae has 2 base programs. The lower rate program is what we call the Achieve the Dream program. That has lower household income limits and a lower interest rate. I think the rate on that right now without DPAL, well, there's a rate slide in here, so I don't want to guess. I think it's 5.25 though, with no DPAL. I'm not sure what the conventional 30-year fixed or FHA is nowadays, but typically that is a below market interest rate program, right, that has access to the down payment assistance loan as well. And then the original Sonny Mae program is what we call the low interest rate program. That has higher household income limits. And I do have a slide in here with some examples of household income limits for you guys to get a feel. I mean, the income limits, I think, are pretty generous for the programs. So let's move on to the next slide. So Homes for Veterans is another Sonny Mae program. It's not a VA loan, right? It's a Sonny Mae loan with additional benefits for veterans. The primary additional benefits is they get a higher household income limit. They get our lowest rate, which is at Achieving the Dream rate. And there's no bump in interest rate if they use the Sonny Mae down payment assistance loan on their purchase. Also, we have a purchase rehab program, right? That program we call Remodel New York. It's like a 203K or a Fannie Mae home style, right? Where your borrower can finance both the purchase price of the home and repairs into one first mortgage to help kind of save them money on the cost of financing those repairs. We do a lot of training on it. And like I said, it operates very similar to the 203K or the Fannie Mae home style. We at Sonny Mae do the escrow repair account administration post closing. So we purchase a loan from you, we set up the repair escrow account, and we have a repair escrow administrator who then works with your borrowers and their contractors to disperse the money as the repairs take place. One of the features you can get with that Remodel New York, right, purchase rehab loan is we have a program called the Neighborhood Revitalization Program. Now, this is for borrowers who are Achieve the Dream eligible and are purchasing a house that needs, upgrades to it, or maintenance to it, or repairs to it to take care of code violations or health and safety issues. And it isn't just, and I should have corrected this in the slide, I should have seen this, but it's not just for vacant properties anymore, and it's available in every county in New York State. So that's a flaw in this slide. So it is available every county in New York State. It's for Achieve the Dream eligible borrowers purchasing a home that needs repairs. And so what that means is, let's say your borrower is purchasing a home and it needs $30,000 of repairs. We'll provide through this Neighborhood Revitalization Program subsidy $20,000 of the money going into the repair escrow account to take care of those repairs. And that way your borrower, if you're familiar with purchase rehab lending, that in that case, your borrower then only needs to finance the other $10,000 of the repair escrow account from their loan amount. So it lowers the amount that the borrower has to borrow in their mortgage. Really cool program. We've had a lot of success with it over, I'm going to say it's probably been 7 years or so that we've been doing that NRP program. So this is a slide with some examples of Sonny Mae household income limits. So these are Achieving the Dream. This is our lower rate program, household income limits. I just took a snapshot of it varies from county to county, right? So for the Achieving the Dream program and for the low interest rate program, they each have a different household income limit that may vary by county. So you can see in the capital region, right, for a property that's in a non-target area for a 1 or 2 person household, the household income limit is $84,800. If the property is in a target area, that limit goes up to $101,760. For 3+ person households, so that would be your husband, wife, 1 child, or 2 spouses, 1 child scenario, or 1 parent and 2 child, whatever it is to get them to 3 or more people in that household. The income limit for a property that's in a non-target area is $97,520, and it's $118,720 for properties in a target area. Target areas are defined by IRS as areas that tend to be lower income census tracts. So they're trying to encourage people to purchase in those areas with the higher household income limits. And also, if your borrower purchases in a target area, the first-time home buyer requirement is waived. As many of you probably know, most Sonny Mae loans require that the borrower be a first-time home buyer. And there's a definition in here on one of the slides for what we define as a first-time home buyer. So next slide, I think, will show us kind of the difference. Downstate, you can see in Westchester County, right, for non-target 1 and 2 person household borrowers, household income limit of $133,050. If it's a 3+ person household, household income limit of $155,230. So the income limits kind of move with, right, the median income limits in a particular county. So next slide, right? This is the Sonny Mae Achieving the Dream, just some of the features of it. And again, this was kind of originally designed for borrowers. So as low as 3% down payment, which to us in the mortgage business means 97% LTV, and that's for 1 and 2 family homes and for condos. So if you have borrowers looking to purchase condos, which is a great affordable option for first-time homebuyers, the other thing, and there's not a slide in here on this, that Sunny May features, is we do pretty quick and reasonable spot approvals on condo projects. Essentially, what we ask for is a completed condo PUD questionnaire filled out by the association. It gives us the information we need. You submit that to us, and usually within 24 to 48 hours, we've given spot approval for a purchase of a unit in that condo project. So we don't maintain an approved list, but it's really easy to get a spot approval for a condo, and it's the same thing for a co-op, right? We do spot approvals with a questionnaire on co-ops. We don't always need a full package, right? That includes financials and things like that. Sometimes we do ask for financials, but most of the time, typically it's done within 24 hours with just a questionnaire. So great option for first-time home buyers, which is condos. So, you know, they can do a condo now with 97% financing. And of course, we have the 3% down payment assistance loan. And, you know, you can use seller concessions to make up for some of the other money. There's some slides in here with some math on it as well to show you that. So 3% down payment, 1% of the purchase price, right? The borrower has to document that they have 1% of the purchase price in their own funds, because they may be using gift funds or grant or other things where they don't necessarily come out of pocket with that 1%. But if the LTV is over 80%, then we want to make sure that they have at least 1% of the purchase price in their own funds documented in their bank account at time of application, just because we like to see they have a little skin in the game. 10% down payment on 3 and 4 family homes, which again, I think we get some fallout from FHA for that program. Down payment assistance loan, right? We've talked about that. It's 3% of the purchase price up to $15,000 on the Achieving the Dream, as well as the low interest rate program. Borrowers can allocate that money, right? If they have some other grant to cover down payment, they can use our down payment assistance loan to cover closing costs. So it can be allocated toward closing costs or down payment, the down payment assistance loan. As we mentioned before, flexible credit requirements, right? We can use alternative credit, and we're going to talk more about Give Us Credit and how that works. For honorably discharged veterans or active military personnel, well, actually, just the honorably discharged veterans, the first-time home buyer requirement gets waived for honorably discharged veterans, and they get our lowest available rate. That's that homes for veterans feature that you can add on. And when you add features to Sunny May loans, the other thing, and I don't think there's a slide in here for this, there's no pricing overlays, which I think Fannie Mae is going to, right, on some of their affordable products as well. But there's no pricing overlays on Sunny Mae products. We keep it really simple on the pricing side. The rate you register and lock them out, even if you're adding like the Remodel New York feature or the neighborhood revitalization feature or homes for veterans or some additional feature, there's no overlay in rate. Whatever income bucket that borrower falls into, right? Is it the Achieving the Dream or is it the low interest rate program? That's the rate the borrower gets with no points. So the low interest rate program, it's underwritten the same, right? It just has a higher household income limit, has the same, you know, debt to income ratios. And I don't think there's a slide in here on this, but our debt to income ratios are 40% max housing ratio, 45% max total debt to income ratio. We're pretty firm with those unless there's some pretty good compensating factors. We have an automated underwriting system called Sunny Mae Express that we use to underwrite these loans with the lenders. And Sunny Mae Express will always give you kind of a hard stop at a ratio of higher than 40% for housing or 45% for total debt to income ratio. Again, the down payment assistance loan and the same flexible credit requirements for the low interest rate program as you get on the Achieving the Dream program. So the Sunny Mae Neighborhood Revitalization Program, I tried to describe this to you earlier without the slide. Now I think I'll do a better job with the assistance of the slide. So it's up to $20,000 in rehabilitation assistance for repairs on the purchase of a home. So that would turn your loan into the purchase rehab loan, right? What we call Remodel New York. There's a first-time home buyer requirement on that. This program now, the NRP program, is for Achieving the Dream eligible borrowers, which means they have to be first-time home buyer. They have to be within the income limits of the Achieving the Dream program. They can still use on top of the NRP $20,000 funds. They can also access the DPAL, right? The down payment assistance loan of 3% of the purchase price. And again, they have to qualify as either Achieving the Dream or Homes for Veterans. And like every Sonny Mae loan, right, the home has to serve as the borrower's primary residence. So here's our current rates as of this morning. So you can see there's two rates for each program, right? There's one with the DPAL and there's one rate, lower rate without the DPAL. So on the low interest rate program, which has the higher household income limit, today's rate is 5.875. If they're using the DPAL, it would bump their rate to 6.25. On the Achieving the Dream and the Homes for Veterans and Graduate to Homeownership, the base rate with no DPAL is 5.25%. Again, I'm not sure where the conventional rates are today. So, but typically that would be under market. If they use the DPAL on the Achieve the Dream program, we bump the rate to 5.625. The reason for that rate bump for using the DPAL is that's how we kind of refill the bucket of DPAL funds, is by bumping that interest rate. But on the Homes for Veterans and the Graduate to Homeownership program, there is no bump in rate for using the DPAL. And we have a Habitat for Humanity program. So if you have relationships with Habitat for Humanity, Habitat for Humanity borrowers can use Sonny Mae financing on a 30-year fixed rate loan at 2% if they're purchasing a property from Habitat for Humanity. There's some other benefits that we can get into if you dig into that program as well. But I don't think we have time to do that today. So next slide, please. These are the loan limits for Sonny Mae. So up here in the upstate area where I live and work primarily, we never bump into these loan limits, right? But down in New York City, Long Island, Westchester County, you may bump into these loan limits. So for a single family or condo, we go to 97% loan to value up to a loan limit of 726,200, right? And the borrower has to have 1% of their own funds of the purchase price in their own funds at time of application. For two family properties, you can see, right, we'll go to 97% up to 726.2. Between 726.2 and 800, we'll go to 95%. And for loans over 800,000 up to a max of $1.1 million and change, we will go to 90% loan to value. Co-ops, 95% up to 726.2. And then above that up to 806, we go to 90%. And then on the 3 and 4 families, right, you can see 90% with 3% of their own funds, and or if it's above 800,000, 5% of their own funds. So as I mentioned before, Sonny Mae is extremely grant friendly. So Sonny Mae mortgages can be combined with grants and subsidies from government agencies, right, from nonprofit housing counseling agencies, the Home Buyers Dream Program, which I think is the Federal Home Loan Bank program. So for those nonprofit housing counseling agencies, if you and or your borrowers Google Home Smart New York, they'll get to the page where they can get in touch with these folks. And again, they do pre-purchase home buyer education, as they help borrowers sometimes with credit repair, and they also have access to many grant programs that come through the state of New York, what we call the Affordable Housing Corporation, AHC grants. So they're really helpful, and they kind of know where the gold is buried, right, throughout the state for these different grant programs. So having your buyers and your prospective buyers reaching out to them is not a bad idea. You'll still write the loan. They'll get great advice from them. They'll get pre-purchase home buyer education, which will make them a more prepared home buyer, right? They'll hear it from somebody other than you, what they have to do to be qualified as a home buyer, what their credit needs to look like, what documents they need to have, right? Pay stubs, W-2s, bank statements, tax returns, all that. They'll kind of walk them through that. So you're going to get an easier borrower to work with if they've been working with the nonprofit housing counseling agencies. So again, no combined loan to value limits. So we talked a little bit about this, right? The Sonny Mae Remodel New York option. This is our purchase rehab loan program. It's for buyers purchasing a home in need of repairs, and using that program, just similar to like a 203K or a Fannie Mae home style, they can finance the repairs that they want or need to do to the property after they own it into their purchase mortgage and save them money on that financing. Sonny Mae's Home for Veterans. And again, we talked a little bit about this, right? It's for U.S. military veterans, active duty military, members of the National Guard. They can receive down payment assistance, financing for renovations, at no additional cost. The first time home buyer requirement is also waived for eligible veterans. and or their spouses, right? One of the unique things to the Sonny Mae Homes for Veterans program that's different from, I think, the VA program, and you guys would correct me if I'm wrong, but is the borrower can have a co-borrower who's not a spouse. If the veteran spouse doesn't qualify for some reason, the veteran spouse can go on the loan by themselves and get the Homes for Veterans benefits as well. So it offers some flexibilities that you don't always get from the VA program. We don't do a ton of it because the VA program is a pretty awesome program, but it offers some flexibility, right? You can add the purchase rehab feature to the Homes for Veterans program, which I don't think you can do with a VA loan. So whenever you're dealing with veterans or active military personnel, it's always a good idea to kind of give a look to the Sonny Mae Homes for Veterans program. So this is kind of an example, right? If you Google where you find different affordable housing counseling agencies, right? I just went in and took a screenshot. I Googled Albany Housing Counseling Agency, and it came up with the agencies that work in Albany County, right? The Affordable Housing Partnership is in the city of Albany, the Albany County Rural Housing Alliance, United Tenants isn't so much for home buyers. And then in Schenectady, there's what's called Better Neighborhoods, Inc. They're another one of those nonprofit housing counseling agencies that does the pre-purchase education that can have access to grant funds for your borrowers, et cetera. So again, the benefits, and I think I already pitched you on these in a previous slide. Benefits to home buyer counseling for you guys, right? In the mortgage business is you get better educated home buyers. They're going to be better prepared to provide you with the documentation you need. They'll probably shop better and smarter because they've been educated and get a better price for their home, right? Fewer surprises along the way because they've been kind of educated on the process. So hopefully they end up with a lower monthly payment and they are more successful home buyers. And I think there are studies to show that there is a big difference, right? A much lower default rate for home buyers who took pre-purchase home buyer education than for first-time home buyers who didn't. So we're going to do like some sample math of a Sonny Mae transaction, just to kind of show you guys how you can kind of build these and get your borrowers in for less money out of pocket. So we're using a sample where the purchase price of the home is $200,000. They're going to use the Sonny Mae DPAL for their down payment of $6,000, right, which means they're going to have a 97 LTV. They're going to have a loan amount of $194,000. We're assuming their closing costs and escrows come in at about $12,000. So on Sonny Mae loans, right, with an LTV over 90%, this one would be a 97, we allow a 3% seller concession to cover closing costs. So you get seller pays of $6,000, right? You've got the down payment covered with the DPAL. So then what's left for the borrower to come up with either through gift or grant or their own funds is about $6,000 and a $200,000 purchase. So $6,000 out of pocket and or less if they can find some grant money, can get a buyer into a $200,000 home with a Sonny Mae loan at a great interest rate, with a low monthly payment. So here's some sample math for a purchase rehab transaction. So here we've got a home purchase price of $150,000. The repair escrow, and that was the money that's put into the repair escrow at time of closing to fund the repairs that are scheduled to be done to the property, right? That's all going to be set up prior to closing. In most cases, they'll use like a HUD 203K consultant to come up with a specification of repairs. They'll get a contractor and lock in their price for the contractor doing those repairs. So in this example, right, the base repairs were probably an amount of about $40,000, but there's other items that go into the repair escrow, including a contingency reserve, usually of 15%, and inspection and money for inspection fees, things like that. So they would end up with a total repair escrow of about $50,000. And if it's repairs, right, for an achieving the dream eligible borrower that are necessary repairs for health and safety, they could access Sonny Mae NRP funds of $20,000, right? And again, that's like that money functions for the borrower once they've used it for the repairs. It sits just like our down payment assistance loan is a second lien on the property, and it's a zero interest, zero payment loan that gets forgiven over 10 years so that at the end of 10 years, it's amortized down to zero and they haven't had to make any payments on it. So it minimizes the amount, right, that they have to finance in their loan, because now even though they've got a $150,000 purchase price and a $50,000 repair escrow, which is $200,000 acquisition cost. And it looks like the math in here is not correct. That borrower acquisition cost is 200,000 minus the 20,000 NRP funds, right? So they're only looking to finance now out of that 200,000 acquisition cost, $180,000. They can access the SONYMA DPAL, right, on the 200,000 acquisition cost. So they would get a $6,000 DPAL. Out of that 180, right, that they're financing, which is the purchase price plus the repair escrow minus the NRP funds, 97% of that would be a loan amount of $174,600. If their closing costs and escrows were $12,000 and they got seller paid, right? So we can use the seller concessions, but those are limited by the purchase price here. So they would only be able to do $4,500 in seller concessions. But again, you're getting a borrower into a home on a purchase rehab transaction without a pocket money of about $6,900 or less if they could access some other grant or gift program. And you can see it. That's a, I don't, honestly, I don't remember what interest rate I used to generate that payment. It might be an interest rate that no longer exists, but that's an example of a payment. So kind of just the math and how it flows in a SONYMA deal and how you can put a transaction together to kind of get them a great deal, get them an affordable payment, and minimize the amount of money the borrower has to come up with out of pocket, which generally we find is the biggest obstacle for first-time home buyers in New York State. Is they have the income to qualify for the loan, but it's putting together the money, right? The out-of-pocket money to get the cash to close money that we would think of it as in the mortgage business to get into the home. So the down payment assistance really helps with that. So as we mentioned, most SONYMA home buyers, right, unless they're purchasing in a target area or they're a veteran, have to be first-time home buyers. So our definition of a first-time home buyer at SONYMA is a person who has not had ownership interest in his or her primary residence at any time during the 3-year period prior to the date of application for the SONYMA loan. And at the time of making the loan application to SONYMA and at the time of closing, they don't own any other property like a vacation home or an investment property. So they may have owned a home in the past. They may have even owned a home in the past 3 years, but if it wasn't their primary residence, that's not a disqualifier. They just can't own any other properties when they're doing this process. So 3 years is the number for first-time home buyer consideration. Credit requirements. So one thing I'll tell you, SONYMA does not like demonstrated poor credit. But beyond that, we'll do manual underwrites. We'll allow several different options for people, especially because we're dealing with first-time home buyers. They tend to be younger and they might not have the credit depth of other people. So we don't have a minimum credit score, right? Credit score is not even considered in approving a SONYMA loan by the automated underwriting system. At least one borrower, and this is for regular underwriting, right? This is what our automated system looks for. At least one borrower should have 3 trade lines, either on their credit report or through alternative trade lines that they can document, right? If they're paying their phone bills on time or their car insurance monthly on time or their utility bills monthly on time, and you can document it, then they may not need any trade lines on the credit report. So that's our traditional underwriting guideline. 3 trade lines that have been open for at least 12 months and active in the past 24 months is the credit depth requirement we look for. Just one borrower in the transaction has to meet that credit depth requirement. So that's our traditional underwriting. And you can see I put the thing in parentheses here, unless GUC eligible. GUC stands for give us credit, and we're going to talk more about that. So if they had a prior payment of a pattern of late payments, a couple of years ago, they had a bunch of 60-day lates or 30-day lates, but in the past 24 months, they've recovered and been pretty clean, then we will typically accept that borrower with written explanations. For the most part, collection accounts and judgments have to be paid prior to closing. There are some exceptions to that for medical collections. And again, if the borrower can't meet the credit depth requirements on their own, they can use a guarantor and or a non-occupant co-borrower to both qualify for the credit depth and also to help with debt to income ratio. And as we talked about, right, SONYMA loans have household income limits, but the co-signers, non-occupant co-borrowers and or guarantors we don't count those people's income toward the household income limit on the SONYMA loan programs. So ask about Sunny May Give Us Credit, right? If you are a participating lender, or if after today's presentation, you decide you want to become a Sunny May participating lender, you can reach out to me. But we want to talk a little bit here about Give Us Credit, right? This is, to me, is a really cool program that's really offers some great benefits to people who you otherwise can't qualify for a mortgage loan. So if we go to the next slide, so we developed this, right? Sunny May set up a minority kind of lending group that met several times, came up with recommendations that we made to our underwriting side, and then they accepted many of these to help, I think, create. And we've been testing this, I'm going to say, we've been doing it for probably at least 3 years, and I don't think these loans perform any differently, which is good, right? Because we're doing lighter documentation. These loans don't perform, they perform just as well as loans where the borrower meets the traditional guidelines. So we've designed these how these applicants are considered in underwriting by identifying criteria that focus on layered strengths. If you got somebody who doesn't really have any credit history, good or bad, but they've been paying their rent and or paying their bills, and there's nothing on there to indicate that they aren't a good credit risk, we're going to assume that they're going to pay their bills going forward and give us credit. So the neat thing to you guys, I think, is in the next slide that will get you a little bit, well, if you're a nerdy mortgage guy like me, it will get you a little bit excited. We bumped back to the previous slide by accident. So, right, our traditional guideline is 3 trade lines with 12 months history each. If you have a borrower who can document 12 months rent payment history on time, then they don't need any trade lines on their credit report. They don't need a FICO score. They don't need any credit history other than that 12 months of rent history. Right now, we accept it has to be a VOR from a management company, or canceled checks, or 12 months bank statements, or some way to document it. We don't accept like private verifications of rent from private landlords. So if they can document 12 months rent payment history acceptably, they don't have to have anything on their credit report. They don't have to have a FICO score. They don't have to have any other credit history, and you can get them approved for a Sunny May loan at all the, with the same LTV, availability of the DPAL, all that we've talked about in this presentation. So to me, that's like a huge game changer for many people. And right, if you're a loan officer, it's a great product to kind of go out and promote to your referral sources. Second feature of this, right? Let's say that borrower can't document their rent payment history. So they have no trade lines, they have no rent history. If they have a housing ratio of 35 or less and a total debt to income of 40 or less, which is going to be because they don't really have any other debts, right? Because they're not on the credit report. So if the DTI is 35, 40 or lower, and they can verify 2 months of reserves after closing, and they have stable employment history, you can get that borrower approved for a Sunny May loan with no credit score, no credit history, but stable employment history, right? That results in ratios of 35, 40 or less, and 2 months reserves, 2 months of PITI payments in reserves. So again, that's like really cool way to go out and maybe market to referral sources, but also to get people into homes who we've proven, I think, with this program are credit worthy, but just don't meet traditional mortgage guidelines. So it's kind of a game changer for a lot of people. All right, so income employment requirements. We look for a 2-year employment history, minimal gaps in employment. It's okay to have been in school, right? So if they've worked at a job for 1 year and the year prior to that, they were in school studying, right? So they were in nursing school and then they got out and they've been a nurse for a year. That counts as 2 years of employment history for us. So okay to have been in school. Right, what we're looking for is reliable, stable income that we can use to underwrite the loan and come up with a debt to income ratio. Other requirements, right? Make sure they have, do they have a savings history, enough cash to close? Their current housing, do they pay their, sometimes, right, if we got a case maybe where the ratio is a little high or something else is a little weird, maybe even some past late payments on stuff, our underwriters will ask if they can prove rent payment history. And also they'll look at the payment shock thing from the past rent payment history as well, to use that as a compensating factor. Right? Most borrowers, almost all borrowers for Sunny May loans have to do the pre-purchase home buyer education. And again, they have to have that 1% or 3% of their own funds to be qualified for a Sunny May loan. So kind of benefit recap, we'll wind it down for you a little bit, right? Up to 97% loan to value, 1% owned funds for the borrowers. For single family homes, that includes condos, that also includes double wides on land on permanent foundations, and also for 2-family homes. As low as 10% down payment on 3 and 4 family homes, 3% of their own funds, no points on Sonny Mae loans, low fixed interest rates, down payment assistance available on all Sonny Mae loans, purchase rehab assistance and financing available for borrowers. And again, they can qualify with no credit history and no FICO score. So that's all I have for you all today. If there's any questions, I'd love to hear them and answer them as best I can for you.
Bill, fantastic. This is Brian. We do have a question came through by Thomas. He asked, why can't mortgage brokers originate these through approved Sonny Mae lenders as a third-party origination or TPL?
I can't necessarily speak to the why, because I'm not the decision maker on it. We just don't allow it. They're just wary of third-party originations. Now, I was a mortgage broker for many, many years, so my bias would be to allow them to do it. And actually, back when I had my mortgage company, we could do it through participating banks. But so I don't know. I can't speak to the why. I've not been informed.
Yeah, it's curious. Maybe IRS reporting requirement. Who knows? But that's a good question. We'll look into that. Thomas, excellent question. Another question came in. Maybe you could expand a little bit on some of the eligible repairs that could be paid for with the $20,000 from the Rehab New York.
Okay, so the eligible repairs on that, so they can't be cosmetic on that, right? If they're going to be covered by that subsidy money, the NRP funds of $20,000, they have to be necessary repairs, either to bring their property up to code, or for health or safety reasons, or for handicap accessibility, things like that. If your borrower just wants to put in a prettier bathroom, they can finance that into the loan amount on a purchase rehab loan, but it wouldn't be eligible for the NRP funds. So health and safety, things to bring it up to code, and anything that's handicap accessible related, and also energy efficiency related, right? If they need, like if putting in a new furnace would make it way more energy efficient, and that's a recommendation, then they can do that as well.
Excellent. Does the as completed value play a role? Doesn't seem like it does, because of the there's no CLTV limitations with the financing.
Well, it does actually. So the after improve, we're going to compare the first mortgage amount to the after improved value and or the total acquisition cost, right? The purchase price plus the total repair escrow. And we're still maxed out like we are in any Sonny Mae loan at 97% loan to value. So yes, thank you for bringing that up, because it wasn't in the slides. That's a great question. The after improved value is the critical number that we use to tell us what our loan to value is, as well as the acquisition cost.
Excellent. I mean, it sounds like we've got a cocktail here of us being a Sonny Mae approved lender, working with nonprofit housing counseling agencies to refer for other assistance grants and homebuyer education. And the third thing would be lender awareness. And I think that's what we're trying to accomplish here, is to make everybody aware these programs do exist and they're good. Well,
it's funny how over the last year, as interest rates went up and refinances went away, lender awareness of Sonny Mae has skyrocketed. So
you're in the limelight. Yeah, it is.
Well, again, we've always only done purchase transactions, right? And when rates, we do tend to trail the market on rates, right? So when rates were going up, we were trailing the market and we were always below market. So that really helped. And that did increase lender awareness. And we have several, right? So to do Sonny Mae loans, you have to be what's called a participating lender. There's a process to become a participating lender. There's a few rules to it. But we probably have at this point more new participating lenders coming on, or that have just recently come on, than we have had in the last 5 or 6 years. So it's the awareness. The market creates awareness for these things.
And I think it's like, to your point, I think it's a market need, given the home affordability and the cost of rent going up. Based on your math, that monthly mortgage payment is not too dissimilar from a rent payment. In some cases could be lower, many cases could be lower.
Yeah.
So that, and the other factor that I see is, from a regulatory standpoint, New York State DFS is really on a push for community reinvestment, in particular the lending test. So the way things are set up, where mortgage value or home values have gone up so dramatically, it's squeezed a lot of those first-time home buyers out of the market. And programs like SONYMA and others, high LTV financing, specifically tailored to that first-time home buyer, and also low to moderate income census tracts, really from a regulatory standpoint, fills a hole in a product menu that a lender should have to be compliant with that. So I think you're in the right spot here, Bill. And,
Yeah, I mean, we have a defined spot that we operate within, and we're always kind of working to do a better job within that spot. I mean, one of our real goals, especially with this give us credit underwriting, is we feel like we've kind of failed when it comes to minority lending, right? Our minority lending numbers aren't anywhere near where our goals are for them. So we're always trying to kind of pitch it to minority communities and work with the nonprofit housing counseling agencies and come up with some underwriting innovations that can allow us to attract more and allow more and help more, right? Qualified minorities get into homes.
Excellent. Not to mention underbanked individuals with the credit provisions that you had gone through. A lot of underbanked individuals just have never, it's just a pretty steep hill to climb to get to that point where you can pass or get approved through traditional underwriting methods. And that's another trend that's been emerging, and it's got some momentum. So it's good to hear that you pivoted to that.
Well, I've always envied those people who don't have any debts. Now we can actually help them get into a home.
Yeah.
Things like give us credit.
Well said. So I think, thank you, Bill. I think we're going to wrap it up here. If there are no more questions, I really appreciate you taking your time, and everybody in the audience, the participants, thank you very much for taking your time to be part of this Affordable Friday with Bill Teague and SONYMA, the Mortgage Bankers Association of New York. So on that, I appreciate your time. I'll throw it back to Christina to close out the meeting.
Okay, great. Again, thank you for spending your time with us today. And our next installment of Affordable Friday is going to be Friday, March 17th at noon. Check out our website for ways to register, and have a great day. Thanks very much.